Uh, Good evening, everyone. Welcome to the workshop on algorithmic trading and quantitative finance. I hope you all are fine and excited to learn about this. So, yeah, today is the day one of the workshop. Am I audible? Can someone please confirm?
Yes, you are.
Okay. So, the highlights of the workshop. So it will be a 5-day workshop covering topics from basic quantitative finance and building algorithmic trading systems. And we will be giving you hands-on experience in developing a trading strategy, backtesting, and deploying it live using the trading API. Basically, we are conducting this workshop so that we encourage students to understand the field of quantitative finance and explore it as a career option. Next up, so we have two speakers for our complete 5-day workshop. First, it's Harkishan Sinbania. Okay, so he is a student in our BSc degree only. He is in diploma first term, and he is a quantitative trader for past 4 years with experience in developing trading systems and stress testing strategies. Previously, he worked as a trader in a proprietary trading firm and as a developer in Hudson and Thames Quantitative Research. So day one, day two, and day five will be done by Harkishan, and the day three and day four will be done by Rahul Chaudhary, who is a software engineer at Alpaca. And he will be giving he will be sending us recorded sessions, and we'll be playing it on day three and day four. So yeah, so I would like to hand over the mic to Harkishan.
Good evening, guys. Gagni, thank you for the introduction. And I would like to take forward with the session. So, Gagni, next slide, please. Okay. As you might known, this is a quantitative finance workshop. So, like we would give you some hands-on experience on developing trading strategies. So we expect you to have some understanding of Python, at least intermediate level of understanding of Python. So we'll be heavily using Python for developing trading strategies, for backtesting them. So using Python and using certain libraries like NumPy and Pandas. And going forward, we also expect you to have knowledge of statistics. So what do I mean by the knowledge of statistics? I mean that basic understanding of statistics, whatever you have done in stats too, hypothesis testing and parameter estimations and all those. We want to have a strong background in probability and statistics. So that is a must for going into the field of quantitative finance and doing some research in this field. And the third thing is not a compulsory one, but it's a good to have knowledge of finance. So knowledge of finance is very optional. Like if you have that, it's very good. Like you can get more out of these sessions. So, but it's not like you need to have it. You need to have it like a prerequisite or something. But yeah, it's good to have. So next slide, please. Okay, so the structure of this workshop. So the first thing is that there will be talks. There will be talks and discussion sessions where we'll be explaining you the theory behind, the intuition behind the trading strategies, intuition behind what is how the market works, what are the different trading strategies deployed, and also on day 5 we have things like how to approach a quantitative research, how to systematically do it on your end. So that's the thing, that the theory part. The second thing comes in coding sessions. So coding sessions involves things like backtesting and developing an algorithm strategy cannot be done only using theory. So you need to learn what's going on in practice. Like theory and practice are two different things in this field, because whatever happens in theory doesn't necessarily reflect in practice. So that's the thing. So you need some hands-on coding experience to develop a trading strategy. The third thing is challenges. So if you don't get hands-on, if you don't try these things by yourself, then you won't get much out of it. So I want you that you get the experience of developing a trading strategy by yourself, deploying it live, see how it trades, definitely it would be in like a safe environment, like a simulated environment, so that like you don't have to involve real money. So yeah, so we'll give you some challenges that involve like real world trading problems, and we want you to do those challenges. So this is what we call end of day tasks. So every day after the session, we'll discuss the end of day task, and that will be given to you. And uh, like every day we'll select two winners will be selected. Those two winners will be selected. They will be given swags from Alpaca. So, and for getting the certificate of this session, you must attempt at least one end of day task. So yeah, that's it. Next slide, please. Okay, so that's it. Like I think this is the opening remarks, and we're done with the opening remarks, and now we'll continue with our first session. So the first session is introduction to financial markets and electronic exchanges. So let me share my screen. Yeah. The presentation is visible, right? Can anyone give me a confirmation?
Yes, it is.
Okay, sure. Okay, so introduction to financial markets and electronic exchanges. First of all, a disclaimer. So this is important from our end. We think like this entire workshop is for educational purposes only. Whatever discussed in this workshop doesn't constitute any sort of like investment advice or trading advice, and any losses incurred due to trading using the ideas explained in this workshop, speakers are not responsible for it. So yeah, whatever we're doing is just fun. So okay, first of all, we'll start with this is the outline. So we'll start with overview of financial markets. We'll continue with explaining types of trading instruments that are available. Then we'll see how electronic exchanges works. What is an electronic exchange for first of all. Then we'll see different order types in that can be used, and then we'll see microstructure and limit order, very important topic. Then we'll see the journey of an order, how an order goes, like from the time you enter that order in a terminal and how it reaches the exchange. So whole process. Okay, so history of financial markets. So stock exchanges, financial markets dates back to like 17th century European, like mostly the stock exchanges were discovered in Europe. So they came up with the idea, let's trade, let's trade something. So the first exchange was Amsterdam Stock Exchange. So during 17th century, people came around, like gathered around, as you can see in this picture, they gathered around, they traded stuff, not necessarily stocks, they traded like the physical products they traded. So that's how like the idea of exchanges started, like people gathered around in the exchange and they traded. So that was the first stock exchange. So then the things became more advanced, like they started like issuing those, what is a sort of certificates where they can transfer sort of ownership of something. So that's how stocks born. And going forward, like 2 or 3 like around three centuries, yeah, 3 centuries. So going forward 3 centuries, we have this thing. So this is like this is called a pit trading. So this is a picture from Chicago Board of Trade. So what is pit trading? Like you might have heard of, like people when it comes to stock market, like there might be an image in our mind that there are people shouting in the pit, like I want to buy that, I want to sell that, this they are bidding. And so that was what it was going on till 1980. So there was pit trading. Pit trading was very famous, and you literally need to come out of like a sweat and like shouting loud. So yeah, pit trading was very famous then. But now you see the 21st century, this is the image of New York Stock Exchange. It's very quiet, there is no shouting people, and hardly you will see like people around the stock exchange, because everything is automated and everything is like electronically managed. So if you this is just the image of New York Stock Exchange. If you see Nasdaq, you won't find images of Nasdaq this way, because Nasdaq is like sits on a server, so there are no people involved in like doing the trades and all, the matching the trades and all manually. So everything is done. So Nasdaq was the first electronic exchanges, by the way. So yeah, that's how stock exchanges started. So what is a stock exchange basically now? So stock exchange is like, you must have the tendency like to trade, like they fulfill the trade. Stock exchanges are a place that fulfills a trade. So what is trade? Like a trade happens when a buy and a sell happens. Like if I buy something from you, then that's a trade, I can call it. And I give some things written, not necessarily money. I give some monetary value to you, and you give me something. So that's trade. So like the thing that what the philosophy is that buyers must find sellers and sellers must find buyers. So this philosophy is fulfilled by exchanges. So like if I want to trade something with you, and like I need specific some specific, I have a specific demand for it, but you may not have the specific need for the service or the product that I'm providing. But there might be some other people who have that need of the service or product that I'm providing. So how to find that those kind of people, it's not easy. So that's why stock exchanges came to place. Like I have shown in this previous picture, like people gathered around. So you can find people with like various interests. So stock exchanges fulfills that. Like stock exchange makes sure that every buyer finds a seller and every seller finds a buyer. So that's what's fulfilled. So if you see the structure, there is a trader. There are two traders. You can consider some of them like this may be a proprietary trading firm, or like what to say, maybe a pension fund or something like that, that trading directly. They can either directly trade with exchange, or they can go through a broker and go to the exchange. So broker on behalf of the trader executes the trade on the exchange. So there are also something called these institutions. So who are these institutions? Institutions are like banks. So there are these investment banks. So usually they're called institutions because they facilitate trading. Like exchanges, if you want to buy something, like buy a stock or something, then you need some seller for that thing. Like if you want to buy, suppose a bond doesn't come from thin air. Someone need to sell those bonds to you in order for you to buy them. So that is done by this institution. So institutions are these big players who can like create trades. So they make sure they're mostly like on the sell side. So I'll talk about buy side and sell side. So they usually sell. So they create these bonds and they sell it through exchanges. So trader comes, buys the things from the institutions, or it can happen like peer to peer. Like there is a trader with same interest. So exchanges make like the trade between both of them. So the role of exchanges is to like connect trades. So we'll learn more about brokers, and here is a term that is floating here, that's called market makers. So we'll understand this term more in depth. So what are market makers? Like these institutions are usually the market makers. So they make the market. So whatever is there, like they provide, if there's some stocks needs liquidity. So I'll explain what is liquidity. Liquidity is like, if you want to buy a certain asset, okay, that asset must have like sellers. So if there are high numbers of sellers for that asset, you call that very highly liquid stock, or like highly liquid asset, sorry. So you go there, you can buy that asset. And if there are like also doesn't necessarily that there is high number of sellers, it is very liquid. There also needs to be high number of buyers and sellers. Both sides need to be balanced to be like very liquid. So in exchanges, what happens usually, like people come to buy and there are very less people to sell. So these market makers fill this gap. So usually institutions are the market makers who like sells or buys on like on some conditions, which I'll discuss further in the session. Okay, now moving forward, we'll discuss types of trading instruments. So remember, like I have asked you guys a question during the time of registration. If you're given $100,000, what did you do with it? Very interesting answers came. Like the answers I was expecting was there. So like people give various instruments, like they want to invest, like some of them said I want to invest in real estate, I want to invest in like I want to do a fixed deposit of this, I want to invest in crypto markets, I want to invest in gold, I want to invest in stocks, I want to invest in equities, and so on. Like those are the things like most prevalent on in the answers. So actually what are those are like actually those are trading instruments. So if you want to do some trade, you need a trading instrument first of all. If you have the trading instrument, then you can like do the trade. Without a trading instrument, trade is not facilitated. So trading instruments are like is a way to standardize the way of trading. So there are like several classes of trading instruments. You can say like equities have the stocks, equity indices, IPOs. You can go for fixed income is like fixed deposits, bonds, credit products. So and there are like commodities. Don't get confused by the names of the this classes. So it consider them just a name. So commodities, there are like bullions like gold, silver, all those, and there are crude oils, there are agri commodities, and properties like you can invest in real estates, mortgage-backed securities. So this is more prevalent in US rather than India. And there are also derivatives, like it's a whole topic on its own. So derivatives are the instruments that are derived from these instruments. So mostly equities, fixed income, commodities. So it's like a contract that I put, like whatever is learned about in math, right, about derivatives is like here it's like it's something similar, but just think of it like it is derived from some underlying asset. So behind derivative there is an underlying asset and it's derived from that. So there is like a futures, options, swaps, and forward contracts, and many more. Like there are many more derivatives. So mostly these are most prevalent. So if I say about futures, so like futures have an usually equity that is the underlying asset, and it tracks that asset, and there is a specific like formula to calculate the price of the future contract based on the underlying asset. And there are currencies which you can invest like forex, crypto, and also like there are few other instruments that was in the answers. So this is like ETFs and mutual funds. So yeah, ETFs and mutual funds. And like you can also think some other funds that are available, like Delta One product. I'll explain what is Delta One products in the upcoming lectures. So yeah. Okay, so market participants. Who are the main market participants that participates in making the market? So there is a buy side and there is a sell side. So in buy side, you have retail traders, you have investors, you have asset managers, hedge funds, private equities, proprietary trading firms. On the sell side, as I have said, those are the guys, those are the like usually the banks, the broker dealers, the insurance companies, market makers. So yeah, like these are the two most uh only you can classify like any market participants into these two sides, like either they're on the buy side or sell side. Usually like whatever you have heard of till now, mostly they're on buy side, because sell side is not much known because it's on the investment banking broker dealer side. Like it needs lots of research and time. Like no one can like go on the first day and start making money on the sell side. So sell side is usually tougher than entering the buy side. So yeah, now we come to electronic exchanges. Okay, so first electronic exchanges, as I've said, was started on 1971. So it was NASDAQ. So NASDAQ was the first electronic exchange. And from there on, like by 1992, it accounted for at almost like 42% of the total trading volume in US. So within this few span of like very short span of time, it captured like around 42% of the market. So most of the trading volumes were coming from like this advanced electronic brokers and like traders who use like electronic devices. Like you can see that like this is one of my favorite movie, like Wall Street. So you can see here like a IBM machine sitting here, and like he can dial up like the order, he can punch in the order and it goes to the exchange and it gets executed. Before that, like you have to call the broker, and like you have to shout the broker that I need it, I need this stocks at this quantity at this price. And there they have to like your broker, there is a representative of the broker in the exchange. That guy shouts to get that order filled. So yeah, like it is a very lengthy process. So electronic exchanges made it like, few seconds. Like it takes only few seconds to get the execution. So very fast execution. And after that, like they realized that decimalization can also be happen. Like before that, what is decimalization? I'll explain it. So before that, like whatever stocks were traded, it was traded only in dollars. No cents were involved. Like no decimal prices were involved. But after the electronic exchanges came, they realized that why not like include the cents even. Like then decimalization took place, and like you can see the decimal in the price. So you can even trade like the difference in cents also. So that is where like high frequency traders takes the profit. So okay, and finally what we are interested in, like because of electronic exchanges, it facilitated that API trading feature. So whatever you see here, like you can code trading strategy like in your like preferred language, coding language, and you can send orders. You can send orders to the exchange like straight from your algorithm. So that wouldn't have been possible if like before that, like electronic exchanges were not possible. Like you can still do some analysis on like on your computer based on the data you have, but order placing would be always manual. Like you need to dial up your broker, say that I need that. So yeah, electronic exchanges was like a boon. Okay, so how electronic exchanges actually work? So you see that there's a pool of clients. So there may be like these clients may be like maybe hedge funds, maybe pension funds, private equities, retail traders like me, and there may be like even banks. Sometimes even banks trading desks do that. There are proprietary trading firms, and like these are all clients. They send their orders, and that gets through like order gateway. Like every exchange has some order gateway. Like if you do it, like your broker will know how to send your order through that order gateway. They'll be assigned a particular order gateway. So that order gateway is basically to maintain the traffic of the like incoming orders. So it maintains the traffic, and that order gateway sends your order through a policy. So what is a policy? So policy is like every exchanges has some policy that needs to be satisfied based on like risks. So if you have taken huge leverage, some exchanges might not accept that. And like if you are like placing a huge, like if you want to like sell, suppose if you want to sell 100 million shares of Apple at one go, some exchanges might not accept that because it will significantly move the market. So this policy keeps that in check. Every exchanges have different policies that are available on their website, of course. And then after it passes through a policy, if policy gives it a green check, then it goes to the order matching engine. So order matching engine is like it takes the order, and now it finds like client whom your order needs to be matched with. Like you want to buy, suppose at $100 some XYZ stock. The order matching engine will find some seller who want to sell at $100 of that $100 of the same quantity of stock at the XYZ. Same quantity or like larger or maybe lower. That I'll explain how the order filling works. But basically it matches the price. So that happens. So here you see there is something called a price time matching. So most of the exchanges use price time matching. So what is that? Suppose you send in the order and your friend sends in the order. So you send a second before your friend. So both of you are buying 100 quantity of some stock. Then since you have sent it a second faster than your friend, your order should get executed first, no matter what. So both of you are like willing for the same price. Like both of you are demanding for the same price. Suppose $100 again, but your order will get executed fast, then your friend's order. So this is called price time matching. First price, like priority will be the price, then the time. So that is the thing. There is also one more type of matching called pro rata. So you can read about it. So that is a bit like that is a bit complex, pro rata matching. Okay, so we're talking a lot about algorithmic trading. This workshop is about algorithmic trading. Let me give you a bit like gist of algorithmic trading, right, for right now at least. So development of trading platforms like lead to like this automated executions, and which I've said before, like electronic exchanges came, electronic trading platform came, then this led to automated executions thing, and then it lowered the bars for algorithmic traders, because before that you cannot send orders to the exchange using an electronic signal. You have to call broker, and broker will trade on behalf of you on the floor. That will happen manually. But now it happens to like there is automated execution. So as I've said, that matching engine, so here matching engine is there. So you send the order, it gets executed. So that's like this field of algorithmic trading is not very old. Like you can track back to like the advent of electronic trading. So as soon as the Nasdaq started in 71, from then onwards, like the craze of algorithmic trading went up and up. Before that, it was very little to none. There was also like technologies like DMA, direct market access. So what is that? Direct market access is like if you want like to connect directly with the exchange without going through a broker, like you want to match directly at the exchange level. So broker, what happens, most of your order actually gets matched at the broker level, but nowadays at least. But if you want like to directly send the order to the exchange, then you can do that. You can get direct market access. Then the other thing happens is like you can also get the direct raw data from the exchanges. So raw data, the importance of raw data you will know in the upcoming sessions. So you can get the really low latency nanoseconds level raw data directly from the exchanges. So that is done through like something called FIX. FIX is called Financial Information Exchange. It's a protocol, like how HTTP is a protocol. They send it through FIX. So FIX is very secured and it's used for only for financial information exchange. So most of the exchanges use it to like send you the raw FIX messages. They send you the FIX messages and you need to decrypt it on your side, and they'll show that okay, this order, like every order that comes to the exchanges, a fixed message is generated for the order, and every trade that happens, a fixed message is generated for that too. Like yeah, like that was I was saying, like fixed messages led to like increase in quality of historical data. Before, what happens, there was a like during before 80s, so there were these traders that used to sit at the exchange, note the prices manually, and like put it in a newspaper, and next day people see that in the newspaper, okay, this price, nothing is real time. Nothing was real time. Like you see yesterday's, like whatever you see in the newspaper is like 5 to 6 hours old. But this fixed messages led to like real-time connection with the exchanges, and now you can get, as soon as an order arrives, you can get the quality. So granularity increased, the quality increased. So yeah, that was Tycoon, lower latency. So lower latencies and higher granularity of data give birth to this new breed of algorithmic traders known as high frequency trading. So like you might have heard of it, like it's a really buzzword during like 2011, 2012. Like the thing is the secrecy involved with high frequency trading. So what are high frequency traders? Like they usually like buy and sell securities like in the duration of time. Like the duration of time is very short. Like they usually buy and sell like in a fraction of seconds, and they do it multiple times a day. And then as I said, like those decimalizations help them. Like they crunch those cents and combine those cents. Like those cents like gets combined and turns to like a very profitable thing at the end. So those are high frequency. They really they use this complex algorithms, complex computer algorithms, and they make sure that they are really fast on the market. They make sure that the connection to the exchanges is really good. Like they use something called co-location, that is they place their server directly in the exchanges so that they can, and the latency is very low. And like without computer algorithms, these things is not possible, because like you are analyzing nanoseconds, milliseconds level data, and you want to send multiple orders in a fraction of seconds. Like you're not trading a single asset, you're trading multiple assets at the same time. Like a computer algorithm can monitor multiple assets, multiple markets at the same time. So that is not possible to do it manually. So that is how that algorithmic trading gave the advantage and why it's famous. Okay, so May 6, 2010. Before doing that, like I would like to take a break for a minute. Just give me a minute. Okay. So May 6, 2010. It is the sorry. Do anyone know about May 6, 2010? What is May 6, 2010? You can raise your hand and co-host will unmute you if you want to say about May 6, 2010. Like everyone remembers about 2008 financial crisis, but May 6, 2010. I want to know how many of you know about this. Anyone? Okay. Sunay Mehta, he have raised a hand. Co-host, can you please unmute him?
Hi, am I audible?
Yeah, you're audible.
Yeah, I think if I'm not wrong, the May 6, 2010 was that algo flash crash that happened,
Yeah,
where
right,
all of
right, right.
a sudden everything was crashing very fast.
Right, right, right.
Yeah, yeah,
Yep, thank you.
yeah.
Vinay Kumar raised the hand. Can you please unmute? Vinay?
Hello, am I audible? Hello?
Yes, you're
Yes,
audible.
you are.
Okay, so I was about to say the same thing. It was the infamous flash crash, which was perpetuated by the algorithmic trading community. So there was a algorithm which started it all, and then everybody joined the bandwagon. So there was no stop loss, and the market had to be stopped for quite a while.
Yeah, right. Yeah, thanks, Vinay. Okay, so May 6, 2010, as Vinay and Sunay have pointed out, it was flash crash. So it's very less known. It was, as I've said, like this was perpetuated by an algorithm. People say that some rogue algorithm started a chain of selling, and which triggered other algorithms to sell their position as well, which led to like this big downfall. But especially I would like to bring your focus to the x-axis. So if you see the time, this is morning 10 a.m. and the volatility kicked in at 1 p.m. and nearly like around 245, like this big flash, big crash happened, like around 9.2% of the Dow. This is Dow Jones Industrial, by the way. Like Dow Jones Industrial tracks like few of the like most, the top 30 stocks in US. So it dipped, and within no time, like within few minutes, it recovered again. So this was something like no one have seen before, no one have experienced before, because people know that once market crash, it takes really long time to recover. And the reason behind this was like investigated for a very long period, and like recently, I think last year or the year before that, like they finally found the reason why this happened. So it was investigated a lot by SEC, and various researchers were employed to like do research why this happened, like researchers at Bell Labs and those sort of things at universities and all. So yeah, like people say this is due to algorithms, and it is true, because whatever happened is because of the algorithms. Like algorithm came, they kicked in that selling event, and it triggered. Like you can see like how algorithms behave. Like there is no human involved in algorithms. So if a human sees this, he'd have never sold it at this low. But an algorithm came, he saw that market is falling. Let me kick in my risk management, the risk management that every trading system has. The risk management kicked in, and the sold a rest of their positions. So yeah, it started dipping. And I remember like one of my colleagues saying that he was on the floor, and he saw that the limit order book stopped, literally stopped. It dried out. Every price has zero quantity to like buy or sell. Like limit order book just stuck there. It didn't move further, because at this moment of time, like exchanges has a like risk management system which triggers on its own, like a fail safe kind of thing, which triggers and stop all the market activities by this point. And after some time, that it resumed, and yeah, in this. So like if you're interested in knowing more about flash crash and high frequency trading, I would recommend like reading this book. Quite a good book, like Flash Boys by Michael Lewis. It explains, like, it's not a quantitative read, but yeah, it's an interesting story behind high frequency trading, how it all started. And also I'd recommend two documentaries about the flash crash. So it goes in depth into what happened during the flash crash. So one is this, and one is by the Bloomberg. So okay. Okay, so we'll move on to the order types. So what are the different order types? Mainly, like there are two basic order types, and most of the like order types are derived from this. Like if you see some different order types your broker is offering, it's just derived from like either of this. So the first is market order. So what is a market order? Market order is like if you want to buy a stock right now, you don't have any condition. I just need the stock at any price. Then you go for the market order. You don't have any price in mind. You just need the stock or like that asset. You just go enter a market order, and you just enter the quantity you want to buy, and you click enter. It will give you that. It will give you those quantity at whatever price possible. So it gets executed at the market price. Whatever price is going on in the market, it gets executed at that price. But the price is not guaranteed. So like I will explain how like this price matching works properly when I explain the limit order book. Like when matching happens, it usually like there are people who are like want to like sell to you. If you buy all those all those assets that he is willing to sell, then you must go for some other sellers who might be able to sell you at different price, not necessarily his price, maybe a worse price than what he is offering. He's offering the best price and someone is offering the second best. Like you will go on buying those from in that order. So that way, like it adversely affects your overall average price of each shares that you bought. So that is the like downside of market orders. You'll get the price, like you'll get the execution. Sorry, you'll get the execution. Execution is really fast, but you won't get the price. Price is not guaranteed at all. Usually these type of orders are called takers. So like whoever places this order are called takers. Like they usually consume the liquidity of the market. You go and like you just snatch the liquidity out of that market. So this is market order. And usually if you place some large order, like previously I have said, if you want to place $100 million worth of Apple shares in the market, like there is no single seller who is like at that point. Like it's very rare that at that single point of time there is like a seller who is willing to sell $100 million worth of shares of Apple at the same time. So what we'll do is like there will be like small players who is placing like a very small quantity of those orders in the market. And like if you want to buy that and you're placing a like market order, you will go on like you might even like consume whole liquidity on the sell side. Like you might like buy everything that is available for selling. So that way it significantly moves the market in that direction. Like I'll show you how the price moves, how like the market price is decided in the next slide. You'll understand better about this. And about the next order. So next order is a limit order. So limit order is like you want to buy against the bid and ask price. So whatever happens, like you place either a bid or ask. So bid is usually if you want to buy, you place a bid, and if you want to sell, you put an ask price on that. So those go into the limit order book in the market. And when a like buyer or seller comes, like on the opposite side, suppose you place a bid and someone wants to like sell you at that price, that seller will come and like fill you in. So usually you're just placing some standing orders in the market that might not get executed instantly, but and it is not guaranteed that it will even get executed, because if the market significantly moves away from that price, it will never get executed. What limit orders guarantees is like the certainty that you will get the price. Limit order guarantees that you will get the price. So whatever price you feel, like in limit order, you do need to put the price. Like suppose if you want to buy at $100, like you will only buy 100 shares of some random asset at $100 price. You will not buy if it's like even a cent above it. You'll not buy. Like you say it's too costly for me, I won't buy. Then you place a limit order. As the limit order gets to the exchange, it gets either converted to a bid or a ask. So depending on your order, like if you want to buy or sell. Execution is slow. Sometimes you might get a partial fill. So partial fill is like suppose you want to buy 100 shares, only like 50 of your shares get fulfilled, and rest 50 are still standing. Like 15 is to be filled. So that may also happen. That is very common. And usually these limit order players are considered as makers. So usually they provide liquidity because they are providing some standing orders in the market, and people can come and fill you. So usually you're considered as a liquidity provider. And large orders can be only executed using like limit order. Like as I've said before, like there are policies by the exchanges which might not allow you to pass a large order directly through that matching engine. So limit orders, so there are certain techniques that are used with the limit orders, like breaking down the orders into small pieces of orders and executing it over time. So that can be done using limit orders. That cannot be done like using market orders. So limit orders are used for executing large orders usually. And you might also even place a very large order at the same time, but like and you might not like need to do those things also, like breaking the child, because like if you think like if you don't have the knowledge, like you're just placing a large order as a limit order, then it will eventually get executed. Like it would be slow, it might not even get executed properly, or like you might get some partial fails and rest of them may not get executed forever, but the price is certainly guaranteed. You will like average price will be like, if you enter $100, the average price will be $100. Like it's not that you filled at $100 and you get average price of $110. Like that will happen on market orders, but that will not happen on limit orders. Okay, finally we come to the microstructure and limit order book. Okay, so a limit order book looks like this. So here you have bid price, as I've said. Here I have ask price, and these are the quantities. Okay, these are the quantities. Sorry, these are the quantities, and this is the price. This is for BTC USD. Okay, this is taken from FTX. Date and timestamp is mentioned. So you see, like a buy. Here are some buyers. Here are some buyers who are willing to like buy at this price, and there are this much quantities available at this price. So as if I place a new bid order, like suppose I want to buy 0.01 like BTC USD at this price, I'll place a limit order, then this should get increased to 1.9376. So this will get increased. Similarly for ask price, like who want to sell, they come at this. And if you place a market order of suppose 1 Bitcoin, and I want to buy, then it would get executed here. If I want to buy, it get executed here, and this size will reduce to 9.3346. So it will get this is called the best ask and best bid price. And similarly here you can see that an understanding view, like this is of the limit order book. This is used for like understanding the limit order book. And you can see here the ask price, here are the bid price, and usually the difference between the best bid and best ask is called the spread. Okay, so like I'll explain this better. Like I have some doodling thing, so I'll show you just a minute. Okay, so you can see the whiteboard, right?
Yes, it's visible.
Yeah. Okay, so this is the ask. This is the ask. And this is the bid. So beyond this, whatever you see green, this is the bid and this is the ask. So as I've said, like bid are the orders to buy, like showing interest to buy, and ask are the orders showing interest to sell. And these are the price. Okay, consider this them the price. Now $100 is the mid price. So how to find the mid price? Like as I've said, like this order, this price is considered as best ask. Considered as best ask. And this price is considered as best bid. Now the mid price is found by this formula. Best ask. Just taking the like what to say, the midpoint plus best bid by 2. So 100 is the mid price. Now the difference between these two, like best bid and best ask. So this thing, okay, the difference, sorry. The difference, this is called the spread. So usually, like for a good liquid market, it is considered the spread is very low. But for illiquid market, the spread gets high. So the difference between best bid and best ask gets higher. So that is the definition of liquidity in terms of microstructure. Okay, now suppose let me say how the order matching works. Suppose there is person one, okay, who wants to like buy like he want to buy 100 shares. Okay, let me give some hypothetical values here. 80, 40. These are the like number of shares available in this price from the ask side. This is 80 again. This should be 110, and let this be 40 again. Here 50, 30, 100, 70, 60. Now, if this person sends this is a market order, by the way, I have not defined the price. This is a market order. I've sent this order and it passes to the exchange and it gets to the matching engine. Now matching engine will check like this price. So what is the market price? So current market for the buy. So buy is like he wants to buy from someone who wants to sell. So sellers are this asks. So current market price for him is 110. So the best price he can achieve is 110. Okay, now he has this chunk of order. Okay, suppose this is his chunk of 100. He has to execute against this. So comes, but only 80 is available here. So what will happen? He'll get a partial fill at of 80, and 20 of his shares will still remain like unfilled. Now what will happen? Since it is a market order, the exchange will send this order to the next. Now this is vanished. This is vanished from the order book. This is dried out. No order, no like orders are available at 101. So this whole bar will become 0. So what order the exchange will do? The matching algorithm, it will send this 20 shares to the next best ask. So now this will become the best ask. So now he will get a fill at 102. So what happened? 100 of his shares got executed. 80 of his shares got executed at 101. Of his shares got executed at 101, and 20 of his shares got executed at 102. Okay. So now whatever the price you get here, divided by 2, that is the whatever that is the average price he got. So it is higher than the best. So obviously it will be higher than the, slightly higher than the best. So he didn't get the price that he wanted. Like he specifically, he didn't mention that I wanted this price, of course, but he obviously wanted to execute at the market price, that is 101, but he didn't get the price of 101. He got something higher. So for him, the shares became more costly. But a second person comes, okay. A second person comes and he says that I want to buy 100 shares. He also defines a price. Okay. So defines a price. Price is like 101. So he quotes that the I want to get only executed at the best current best ask. Okay. Now what will happen? I'll erase these things. Now he's 100 shares. Since it's a limit order, but although it's a limit order, it wouldn't be standing in this thing because like it's whatever he's sending, it's a bid. Okay, he's sending a bid at 100 of 100 at 101, bid of 100 and 101. So that chunk of 100, and it's okay, just consider like it's bid. Okay, it is sent to this block. So he sent in 100 shares. Now, since both are opposite, now matching will take place, because matching will take place automatically. Exchanges don't need to like check if the like bars are available or not. If bars are not available at this price, it will go into standing like in market. If we placed at 100, then this thing will come and sit at 100. This whole block will come and sit at 100, and nothing will happen until like an opposite party comes and fill his bid, like an ask comes and fill his bid. But since it's just going towards 101, then and it's 100, here 80 is available. So out of 100, 80 will get executed, and here 20 will remain, and those 20 are this guy's order. So 20 will remain. This barrel gets reduced to 20, and this 20 will remain until a bid comes again here. Okay. Sorry, an ask comes here and fills this 20. His 20 orders will remain here. So he got a partial fill of 80. His order is not fulfilled yet. Suppose someone comes, like a third guy comes, and he says, okay, I want to sell. Suppose I want to sell, like 30 quantities at price. Suppose he mentions the price, suppose 101. Then these guys 30 will come here and gets executed with the 20, and his order will be fulfilled at the same price, and he'll get this 20, and it's done. His order is fully fulfilled. But here 10 remains, as you see, like only 20 of them will get executed. 10 of his orders will remain. Those will be again standing here until an opposite party comes and fills this. Like I have shown these bars in the opposite ends because to highlight and make it easier to understand. Usually it doesn't happen like this. So this is, don't consider this as x-axis or y-axis. Axis is not present. This is not negative. This is not positive. So quantities, these are just quantities. Okay, now that happens. Okay, similar thing will happen at bid. Like if someone says, like a fourth guy comes and says, I want to sell, he places a market order of 50. Those 50 will come immediately and check, he'll get the market price of 99. First of all, like exchange will allocate him like the 99, the best ask. Whatever is available will be given to him. Since 50 is available and he is asking 50, this will get dried up and this will be vanished from this thing. Yeah, so this whole thing will be vanished from here. Now if you see, the spread have increased. Now if you see, the spread have increased because this order is vanished. That's what happens when you send a large order. Suppose you send a large buy order of, suppose a sell order. Okay, sell order of you say 500. Okay, sorry, sell order of 500. It will eat up all of this thing, whatever is left here. All of these things will be vanished and spread will increase even further. And now whatever you see, like in the, as you know, ticker price, like you see thing like in a brokerage terminal or maybe in news or something like this. So like stock price of this XYZ is like 100, and it will show something like a green uptick and saying it is going up by 2% or something, like very rare. 2% never happens. So yeah, it has gone up by 2%. It's very rare that 2%. Okay, so this, whatever you see, the price is the mid price, whatever I calculate from here. Mid price is best ask, best bid, and this thing. But that thing, that price, you can never get executed because there are no orders available to fulfill. Like this is a hypothetical price actually. Whatever the price you see, there is a hypothetical price. you can never get executed at that price because there is no orders available to get fulfilled. So that is the main issue, like with market orders. As I've said, like if you send in a large order, it'll eat up, like either way, like if you send a buy, then it'll eat up these things. This will get vanished. Like it will spread will increase this way. And like if I want to buy, I have to buy at a way higher price. Like suppose everything till like 104, everything vanished. Only like 40 orders of 100 at 105 is available. If you see the mid price will remain almost same. Okay, but if you want to get executed, suppose if you want to execute a buy order, suppose of say 10 shares, you here it will be shown 100, but you will get executed at 105. So $5 difference. It's huge. $5 difference is huge. Okay, I hope that you understand the limit order book. Now let me continue with the slides. Okay, give me a minute. Okay, so limit order book has been explained. Now finally we come to journey of an order. What happens from the moment that you click, you know, I want to buy 100 shares of Apple at this price, or like you don't mention the price. What happens like after you click the enter button? How it's get executed basically at the exchange? Like what happens? Like usually sent to a broker, because like most of us don't get that direct access to the exchanges, and like exchanges over the counter exchanges, those sort of things, except in crypto markets, of course. So first of all, like we have here market participants. Okay, so market participants, like there may be like this proprietary traders, retail traders, there may be like investment banks, there may be like hedge funds managers and so on, like private equity firms. They send in the orders gets to the broker API. They have a layer of broker API, so everyone interacts with the broker API layer. So it passes through a broker API layer, and broker has this system on their own. Like they have an order management system of their own, because like most of the order, like around 90% of the orders gets like masked in the broker level. That doesn't even reach the exchange nowadays. So that happens. Like, so how broker do it? Like they have this order like management system which like matches the order. Like as I've said, like if you if there is a counterparty for a trade to fulfill, it gets matched in the broker level itself. Broker has that legality now. I don't that is, I think it's also valid for India also, but in US for sure that that will happen. US for sure. Okay, then suppose your order doesn't get matched, there is no counterparty to trade with. Your order gets to something called a smart order routing system. Most of the brokers nowadays have this smart order routing system. So there are different venues where your order can get executed, not necessarily an exchange. There are like in India, of course, it's not available, like dark pools. Dark pool concepts are like dark pools are banned, or like they're not considered legal in India, but in US there's something called dark pools. So what are dark pools? Dark pools are like, it provides traders anonymity. Like whatever you see the limit order book, that comes from the exchange, but dark pools are like what to say, sort of exchange that doesn't provide that sort of like clarity. Like that doesn't provide the limit order book. They provide anonymity to the user, because what happens usually it is thought that like if you pass a large order to the exchange, there are these high frequency traders who can like catch on a trade. Like they can see, okay, this large order is coming, and they can purposefully like exploit the trade. Okay, and you might, and the second thing is that the first issue I talked about, you place a large order, take if you place a market order, it will significantly move the market, you will get a very low like you will get a worse price. It will affect you in the negative way. And the second thing is that if you put the limit order, it might take a very long time to execute such a large order. But dark pools, what does, like they say that, okay, we'll give you the market price, whatever market price is available. You send in the order to us. If that liquidity is available, if that counterparty is available, we'll make a trade. If not, then we'll reject your trade. Just that. So this smart order routing system, like it's an algorithm which decide like where to send in these orders. So broker is usually does that. So this is like, like a basic breakdown how like backend of brokers work nowadays, smart brokers works. Okay, so that was about the dark pools execution venues. So if someone needs an optimal execution, yeah, it does that. But if you have the direct access to these venues, then yeah, that is the best. But it's very difficult. So that is what I have said previously is called direct market access. Okay, finally, we come near to the end of this presentation. We have references. So I have mentioned four books specifically. The first three are a very light read, like it gives you the basic understanding how market works, how like algorithmic trading works, basics of those two. It doesn't involve like lots of math and sort of things. But the fourth book is like more research oriented because it's written by academics mostly. I consider this as a very academic book. Like it would like it's very heavy on the mathematics, and it would give you like, if you want really to go in depth of high frequency trading, how it works, about strategies and sort of thing, I would recommend this book. But first three are like, I'd say you should read at least, because to get like the understanding. The first one is like exchanges, trading and exchanges, microstructures for practitioners. The second is algorithmic trading and DMA. It says like how direct access trading works, how co-locations and all those things. And algorithmic trading, in an introduction, like the basic to advanced strategies. So this is also a very great book. I highly recommend. Like this is also a reference to our today's tasks. So you need to read this book. Like like it would give you some idea like how to like work on today's task. Okay, so moving forward, we have interesting activities. We have few activities kept for you so that like it's related, like to understand you, like how you understand the topics and sort of things like taught in this workshop. Okay, the first thing is mystery with the casino game. I would request the co-host to share the Mentimeter link. Okay, Mentimeter link. Just a minute. Okay, so there is a casino. I think there is a casino which offers three different games. A game of rolling a die, fair die, in the table, and the payouts of those three games are given as follows. Okay, if you roll a even number, you will get $12, and if that roll comes to be odd, then you lose that $10. So you need to pay a $10 ticket price to enter that game. Like every game has $10 ticket price. Now game B, if you roll a 6, you'd get $50. And if you lose $10. And game C, if you roll like 1 or 6, you would get $40. And if you roll anything else, you'll lose the $10. So yeah, please go to the link. I'll be stop sharing. Like game, you should select either game A, game B, or game C. Just a minute, let me start sharing the Mentimeter presentation. Okay, we have coming in, responses coming in.
Can you show the rules again?
Yeah, sure. Just a minute. This is the payout actually. Yeah. Payout of 3 games. Like we'll take 1 minute on this. Okay, I think it's the time. Okay. Well, there is like a tie between game A and game C. Okay, quite interesting. Like this is a very, like, what to say, I wouldn't say any answer is right or wrong, but it depends on the way how you think you'd invest. So specifically, like, if you think in terms of statistics and expectations, then game A seems the only promising game out of this, because in long run only game A gives you a positive expectation, game B has 0 expectation, and game C has a negative expectation. So yeah, we'll move on to the second question. So it's about risk aversion. So you're given 3 investment opportunities. The option A is that, like, suppose an investment advisor approaches you and says, okay, I'll give you 3 investment opportunities. He says that option A, there's an 80% chance of winning $300 and 20% chance of just a minute, let me switch the screen so that I can take the, okay, 80% chance of winning $300 and 20% chance of losing $500. Option B, he gives, there is a 100% chance of winning $100. You'll win no matter what. And option C, it says that 80% chance of losing $500 and 20% chance of winning $1,500. Now, like, I want to see, like, which option would you pick? So are you able to answer this?
The question isn't available yet.
Okay, isn't available. Okay, I think I need to present it. Okay, can you check if it's available?
Yeah, it's available now.
Yep. Again, there is like not a right or a wrong answer for this activities. It's just like to understand you, like it's a part of like thing of field of finance called behavioral finance. Like this question is to understand risk aversion, like how many of you are very risk averse, don't like uncertainty at all, don't like to speculate. Okay, investment B seems to be a popular. Investment C, only one. Again, like it's like going to be a tie between investment A and B. Okay, I think, yeah, that's enough. There's a tie between investment A and B. So yeah, investment A, like there is a good chance that of winning $300 if you invest 500. So, but investment B gives you that guaranteed. People who have found the expectation of this to be positive, they have chosen this, and some people who think that, okay, let me not go for that long-term thing and uncertainty and all, let me get that sure shot $100 and go for option B. Yeah, so great. Okay, so I'll be continuing with the final activity. Final activity has a different link. Just hold on a minute. Okay, so I'm sharing my screen again. Okay, it's an investment dilemma. So suppose you were to invest $1,000 and what to say, an investment advisor or some trader comes and suppose you're a manager of a trading firm, comes and shows you, okay, like we have these 3 opportunities. This is a chart, like this is the performance of these 3 assets, and you have to choose any one of these 3. So which one would you choose? Co-host, can you please share the link of this activity too?
Yes, everyone can see that in the chat, I guess.
Okay. Okay, I would give you a little bit of pointer to this. Okay, and the next slide. Oh, sorry, I've revealed it. Them. Just a minute. Okay. Okay, so the first one is a fund called long-term capital management. The second is Dow Jones Industrial Average, and third is US Treasury bond. So yeah. Okay, most of us are going with 1 and very few with 3, and fairly like good number of people with 2. Okay, so fine. Now it's time for reveal. Okay. So this is what happened. If you would have invested here in the first investment, it literally vanished. So it's the story of long-term capital management. So long-term capital management was a quantitative hedge fund. So they employed quantitative trading strategies, but there is that problem with genius kind of thing. So what they fell into trouble that they ignored something called tail risk events. So in normal distribution, there are these tails. So they in their model like didn't take that into consideration, like the extreme tail risk events. And when that occurred, dipped. Like there was really like big words about long-term capital management, and long-term capital management is doing so great. Like it literally beat all the competitions in the market. So as you can see, the performance is quite huge. Like this is Dow Jones Industrial Average. So this is like you can say this is the heartbeat of the US industry. So if this crashes, then the whole world economy will be done. But you can see how like extremely well LTC was performing, and when that extreme event, that very unlikely event happened, it went down and never returned. It was doomed. Okay. And a treasury is like bonds are always stable. It gives you stable growth, stable return. But that is the thing, like risk and return. So you take more risks, you get more return. But that is not always true. There is something called a asymmetric payoff. Like if you venture more into this field of monetary finance, you will know what is asymmetric payoff. Like for a low risk, you can get a high reward kind of thing. So that can happen with options, and it can also happen like is the market makers usually do that, the high frequency traders usually do that. Like their risk is so small because like their reward is small, but they repeat that reward multiple times a day. So those cents, they collect those cents, and the cents turns into a good sum of money by the end of the day. Okay, now I'm open to questions. Yes. So
Vinay, I'm going to unmute now, so you can ask your doubt.
Vinay, hello.
Hi.
Hi.
Am I audible?
Yeah, you were audible.
Yeah, I have 3 questions.
Yeah, sure.
So the first one is a trivial one, which is about the bid-ask spread. So
Right.
basically, the bid-ask spread terminology is with respect to the market participants. rather the market. So if I, as a trader, if I want to buy, I buy at the ask price. And if I want to sell, I buy at the bid price. I mean,
You
I
sell at the
bid
sell price, bid price. Yep, right.
Yeah.
That's correct.
So the ask is from the market side, what they're asking to buy from you, right?
Right.
Okay. The second question is with regard to the order book. So specifically with regard to the Indian context. Say I'm a retail trader and I don't have any direct membership with any stock exchange. So I'm necessarily relying on the broker. So all my trades are routed to the broker, who then does the order matching and then places it with the exchange. And then the trade cycle happens and then trade gets executed. My question is with respect to the visibility of the order book. So when I place a trade with my broker, is my visibility of the bid-ask prices limited to the trades that are happening at the broker level, or do I get placed in the wider market? I mean, the stock exchange order book.
Okay, so that is the issue with the visibility. So you never know. Like if at the same time, like there is a counterparty with the that want to fulfill your order, and that same that order is sent to the broker, that broker will fulfill your order with that counterparty rather than sending it to the exchange. So they report that thing directly to the exchange that this trade happens, but that order is not doesn't get executed at the exchange, but the information gets propagated to the exchange and from exchange to the broker again, and then broker can display that to you.
Okay, so which means to say that if I place a buy order for X security and there's no matching order in the broker's order, that means his clients, his internal clients don't have a seller, that means my trade doesn't get executed at the broker level. I have to wait.
If your order is standing in the limit order book, that means your order has made to the exchange and it's standing in the limit order book of the exchange. And yeah, that's it. Like if another order that reaches the exchange, it fulfills your order, then your order will get executed and filled at that point.
Okay, but what that's done at the exchange. My question is with respect to what happens at the broker level.
At broker level, like they have something similar, like matching engine, but that is like it's less rigorous in terms of policies and all. Like they have their own risk management systems. Like they check your margins, your risk appetites, and all those. They calculate on their own. Every broker has some different risk management engines. So based on that, like if your order arrives and like if your order like doesn't reach the limit order book, then like most of the market orders actually get executed at the broker level. So
yeah, I mean market order, there's no problem because just
your limit your book your order will not be displayed by the broker on a limit order book. So that is what I want to say.
I mean taking a specific example, say my broker's Georgia Securities and I place a buy order with Georgia Securities, and he's not able to find a matching order within his book.
Yeah, then he will send it to exchange. Yeah,
and it gets matched at the exchange level and gets executed at the exchange level.
Yeah, right.
Okay. Thank you. So the third question is a bit more philosophical. I mean, we're all in the game to make money here, and this has been going on for a couple of centuries now. So the big question is, I mean, they say for every winner there's a loser, and we have a lot of adages like it's a zero-sum game.
Zero-sum game, right.
So I mean, you have to win at the cost or expense of somebody. So at some level, it becomes very cutthroat and unethical. So my question is,
definitely,
over these couple of centuries, do we have any empirical evidence, statistical evidence to say that we can, with confidence, say we can get alpha? I mean, the game is about alpha.
Definitely, you can get alpha. We'll talk about alpha like tomorrow, like when we discuss trading strategies.
Right.
Like, that would be one of the topic that I would focus. Like alpha, yeah, there are like lots of like benchmark papers. Like the first thing, like we'll be discussing something called a pairs trading strategy that was discovered like in Morgan Stanley. So there are researchers Morgan Stanley like at the trading desk. So they discovered this idea of pairs trading. So that was something that is new. Like alpha is like currently like there is not kind of like abundance of alpha. Like if you
True.
go 20 years back, if you just run a linear regression, it's fine.
Yes.
You can make money out of it, but currently you have to do very sophisticated stuff to get alpha.
Yeah.
Like that alpha is not available in abundance. Like how you see gold is not available in abundance in currently. Like there is like micro gold, like you have to like mine the rocks, and from there you have to extract those micro golds and like combine to make a gold bar. So similarly, like there are micro alphas available in current market. Like it's, you need a very sophisticated method to discover those.
Exactly. I mean, exactly my point. Exactly my point that given the level of sophistication that has happened, I mean, earlier it was just people who had insider knowledge used to make money back in the 1800s and 1900s. That was banned. Then came the fundamental analysis, then came technical analysis, then came the quant methods. Now in the age of info, and we're now talking of algo trading, HFT and whatnot. Tomorrow it could be something else. Machine learning is percolated into trading.
Yeah,
And
definitely.
as we acknowledge, question of alpha is becoming more and more elusive, and it is just in few hands. So my question is now, given we are not so sophisticated, our resources are limited, as an individual, how do I stay in the game without losing money? Is it even possible to conceive? Is it even conceivable to stand against giants like all the big names in the market? How is it possible for an individual trader like me to survive?
Exactly, that was like the point that I wanted to discuss on day 5. Like it is not possible for like normal retail traders who is sitting in the trading terminal and like making manual trades, doing manual analysis and all those. Like in this you are like fighting against huge computers and algorithms who are like far smarter. Like they're made by these PhDs and like researchers, like best in class. So it's very difficult to fight against them. But like if you want to like make money, like you shouldn't be on the other side, I guess. Like I believe that you should be on that side of the that side of the market where like
so mingle with the big boys.
Yeah, definitely.
So probably we have to do the contrary, because what happens in the media is exactly the opposite of what the market is doing. So there's a lot of bias in the media, in the mainstream media. I mean,
actually,
it's misleading to the investors. Advisory used to say buy, but actually there's a manipulation that happens at the back end, and you've been misled.
This is like quite a controversial topic. Like a few years back when high frequency trading like was on the rise, like there was like big controversy around high frequency trading. Like there are this they call them the predatory algorithms, like which eat up the liquidity in the market and like adversely affects the retail traders and like in the investors and those sort of things. But actually like there is also a plus side to that. Like there would be like both side of the coin. Like high frequency traders, they are usually the market makers nowadays. Like they also provide the liquidity. So yeah, like this is very subjective topic. Like we can go on and on discussing on this.
So I think by the end of the session, my expectation would be to have some takeaways in terms of, as the retailer, what are the tools that are available for people to explore and go forward.
Definitely. Like when I turned as a retail after working in the like private trading firm, I realized that thing, like what I'm like going against. Like you need those arsenals to go against these machines. So you need a machine to fight against the machine. So that's the thing.
I mean, just to take the example of the current scenario, I mean, Ukraine versus Russia, what is happening? Small soldiers are making punctures in big arsenals of Russia. So I think probably we have those kind of pockets where we can exploit as individuals.
Yeah, definitely. There are things like you can discover. Like I will discuss that on day 5, like how to approach for how to do research on your own, how to approach this research. Yeah, definitely.
And a request is with respect to the Indian market, if you can give
Indian market. Okay.
Because there's very little literature available, little help available with respect to the Indian market.
Indian market, like maybe I would take some separate session, because this workshop, like done with like association with Alpaca. Alpaca is like a brokerage trading firm in US.
Right.
So
Right.
yeah,
Okay.
definitely.
Okay. All right. Thanks. First has
Okay.
gone really well. Thank you.
Thank you. Yeah.
Excuse me.
Yeah, Arun, go ahead.
Yeah, I have a question. In a what way this algorithmic trading is different from fundamental analysis and technical analysis?
Yeah, like as I've said, like using algorithmic trading, you can employ those strategies also. But the thing is, you can automate those strategies. Like whatever you're doing manually now, like people are sitting in front of a trading terminal, looking at the charts and making real-time decisions. That is actually called a discretionary trading. So those decisions, if they can be coded, they can be coded with hard logic, that can be also transferred into an algorithm, and it can be traded algorithmically. Like it reduces the human effort. But the most advantage comes when you combine algorithmic trading on quantitative finance. So quantitative finance is which involve mathematical models to like model the market and take decisions that are like based on statistics basically. So there are many strategies like that are developed using quantitative like research and all. So those are sound on the mathematical side, and by nature, if something is mathematical, that can be coded into a logic, and that can be coded as an algorithm. Like quantitative trading gives a huge advantage to a trade. Like whatever said about high frequency trading, right? It would not have been possible for a like trader manually sitting at home, like looking at the terminal and placing orders. Like how much he can do? He can do like at the second he can place like a single order of some X quantities on some Y securities. More than that, he can't do. He can't do that kind of thing. But an algorithm, can execute over like not only a single market. He can execute trades over multiple markets at multiple securities, and like even over like multiple countries. So yeah, that is also possible.
Okay, then what will be the accuracy of this algorithmic trading?
It's very accurate because humans are faulty, algorithms are not. Like, so it's very good. Whatever you code the logic, it will execute that. But you
So it
must make
works
sure that logic is like fully correct. There is no bug in the logic. Whatever you say, it will do.
for every company, right?
Sorry?
So it works for every company, each and every company, right?
Yeah, you can not only like companies, like you can whatever like I have discussed, like the instruments. What if the instrument is traded in a electronic exchange or in some venue where like electronic matching works, you can do algorithmic trading in that. Like given the facilities provided, like API, like we'll be using API, but like the big folks, the institution guys, they use FIX, whatever I said, financial information exchange, that protocol they use for sending those messages of orders and receiving data. Yeah.
Yes, so algorithmic trading can be performed by retail investors, right?
Yeah, definitely.
Okay.
They can be.
Yeah, so thank you.
Yeah. Yara, Vijay.
Yeah, I can hear me.
Yeah.
Yeah, my question is like till now, what we have gone through is like it's just a basic terminology for the market, right? It doesn't depend upon either Indian market or the foreign market. So my question is like in the upcoming session, either are you going deep into this in the Indian market sessions or like foreign market sessions or general one? I'm asking.
See, this session is not market specific. Whatever it is taught, you learn from this, it can be applied to any market. Like given those conditions are met, it can be applied to any. Like I'll give you a very generalized point of view. Today is just the introduction, like to give people, like here are many people who are like who are not exposed to the world of investing and trading, who doesn't know what is an exchanges, how limit order books work, how these things works. But from tomorrow onwards, we'll just go right into algorithmic trading. Algorithmic trading is just about like taking the strategies and all those. It doesn't like discriminate between markets. You can even go into crypto market and like change tweak few of the lines in the code and like execute the same strategy in the crypto market.
Yeah.
So yeah, it doesn't matter. Like market doesn't matter. The knowledge is like generalizable over like whatever assets you want to do.
Yeah, actually, we asked this question is like, I am not sure about this foreign markets, but coming to these Indian markets, there is a variation in the API services that provided by the broker side actually.
Yeah.
So based on that aspect, I asked you because I have done this algorithmic trading 1 year before, but I got some issues there. Due to these API providers, so that's why I asked you in that aspect.
Regarding
Which is-
that, like actually I'll be rolling out a form where we can discuss the questions of these sessions further. Like it's a invite to a Discord server, our Discord server. Actually, there will create a specific thread where we can discuss doubts related to this. There we can discuss about like Indian APIs and all those stuffs, because whatever the thing is, like it's not API specific. You just change the API thing. Like some broker provide you some different like most of the brokers provide you REST API. You just change the API calls and you took that and it will work in like with that broker. So that is the thing. Like I don't want to be that say that I'm a broker specific. I'll teach something that is specific to a certain market. Like I'm taking the example of US market because it's very developed in that way, like you can understand, and India has some like limitations of course, but also I'll discuss that, like sorting and all, you'll have some issues with that, but there is also some way around. So yeah, we can discuss that further, like as I've said in the Discord. So we'll create a private thread in that. So yeah.
Next one is like, do we have this any architectural design, or is like how the data flows, means like how that API
Yeah, definitely
we
you
have
will
to store
have.
this I mean the data storing in the database, and we have to run multiple queries at a time, right, while doing this algorithmic trading.
Query not necessarily, because like I will say how like data flows like from the broker or the exchange to your site, like that works to something called a WebSocket. We'll discuss those things like on like day 2 or day 3 where we'll implement live coding. Okay, where we'll implement how to like live trading, how to implement a live trading strategy in live market. So then I'll discuss that full architecture, like how data comes, how you send orders and all those things. Like I'll explain it from the basic and I'll show the code. We'll code it together. Like there is also a task where you'll be asked to code, like everything will be explained in details. How to send orders, how to receive the data, how to work with the data. So yeah.
Yeah, sure. Yeah, thank you.
Okay, so any more questions from anyone? You can raise your hand. Any questions? Okay, so since there are no questions, I'll move forward with the task for the day. So this is the final thing that we'll do. So let me explain what's the task. This task for day 1, executing a large order. So this is the problem that we have been dealing from the start of this presentation, that I have been saying. How like sending a large order to, even if you do a market order, then it will move the market. If you do a limit order, it's a long time. So what is the optimal strategy to execute a large order? Suppose you're a trader in a proprietary trading firm or hedge fund, and you are asked to execute a large order. How to do that? For this task, I have asked you, like you are asked to sell $1 million worth of Apple shares that the firm has been holding for past 3 months. And I want you to explain what is the optimal strategy to execute this trade that like without significantly impacting the price in the market. Like you don't want that it adversely affects your ultimate PNL. Okay, so I wanted to explain the approach in a Google Doc, and make sure to include if visualizations if you find any. Like write your approach, like how will you approach it, write that, mention, and you can use any resources on the internet and anything you're free to use every resources available, but make sure to reference them at the end, like use some reference and write those as a references. And the last date to submit this is 30th of this month. And as I've said, the reference book. So this is the reference book you can use. So check this book. It has some strategies like VWAP, TWAP. You will understand what those things are, VWAP, TWAPs, and all those. And this is the link to the submission form. Make sure that the Google Doc is visible to every people in the IIT domain. Okay. So is there any questions regarding the task? Any questions? Also, we'll be rolling out the form now. Host Gagnit, can you give the invite for Discord, that form? Just fill out that form, okay? And there will see a link at the top. Go to that link, join our Discord. And if you're not joined, and if you're already joined, still fill the form, like enter your Discord ID so that we can give you the role, and role will give you access to that channel. So there we can discuss this further. If you have any doubt regarding this task also, we can decide that. Yeah, Aditya, you have any some doubt? Yeah, please go on. Aditya, you can unmute.
Yeah, I was wondering if there was like a time limit in which we have to execute the sell of the $1 million shares.
See, I'm saying it optimally execute. The time might not matter in that case. What I want is like significant. It should not significantly impact the price. So that's what I want here.
All right. Well, thank you.
Yeah, the time will matter, but time is secondary. First comes price, then comes time.
All right. So price has a higher priority then. Okay.
Yeah.
Thank you.
Any more doubts? Gagnita, did you roll out the form?
Yes, the forms are in the description box in the chat.
Okay, thank you. Okay, so guys, please fill the form so that, and like if you have any doubts regarding that, you can like post it in the channel and it'll get clarified regarding the task further also. If you can also discuss this task. So remember, like 2 winners will be decided from this task, and by I think end of May we'll distribute the swags and the certificates. So yeah. And remember also that you must attempt at least 1 task. Out of this 5 tasks, you must at least attempt 1 task to get the certificate. So yeah, if no doubts, then thank you very much. See you tomorrow, day 2, same time, 7. Hope you all join. Bye-bye.